Big question is, will it be a quarter point or will he leave rates alone? It affects everybody's wallet. Let's bring in our econ panel. Robert Wolf is here, former UBS chairman and CEO, and Aaron Gibbs, Main Street Asset Management Chief Investment Officer. All right, I've been looking forward to this because we've already had a fabulous discussion before this has even began. Well, let me start with you, Aaron, first, because lay this out for the American people, what's happening at 2 o'clock, how this is going to impact them, why we are here, and what the Federal Reserve is really tasked with here.
So it's about whether we're going to see those rates increase. That means your credit card rates, your mortgage rates, whether lending is going to get tighter, so whether it's easier for you to get a loan or a business loan, all of that, and whether we're going to focus on stabilizing the banking system so that we can sort of get a pause and basically get these crises that we've been seeing happen one day after another under control.
Robert, sorry, I'm top lining here.
All good.
Robert, I'll put up on the screen the higher rates and how they've hurt home buyers. Just take, for example, a monthly payment. If you buy, the average home price in this country right now is about $350,000. You put 20% down. At 3%, your monthly payment was $1,180. At the now 6.6% 30-year mortgage rate, you are almost at $1,800 a month. So now we are waiting a decision 28 minutes from now that could raise those rates even further. So what is this ultimately going to do to the American economy?
Well, a few things. I think they should raise 25 basis points. Actually, after the last labor numbers, I was at 50 basis points. If not for what's gone on for the recent banking crisis, I would have stayed at 50. So I think 25 basis points. They have to separate monetary policy from financial stability. We have a myriad of tools for financial stability, and that can be at a different topic or a different question. With respect to the rates, yeah, it's going to slow down the economy, but I don't think it's going to slow it down into a hard landing recession. I'm just the opposite. I think it's going to slow it down to a point where we see actually wages do better than inflation and purchasing power will go up. I'm much more bullish on where we're going as a country.
All right, and as I mentioned to you, I was looking forward to playing out this brand new sound from Elizabeth Warren. She was stopped by one of our reporters, Grady Trimble, in the hallways earlier today. And to me, play out SOT 4 first, this sounds like she's making an admission that President Biden bailed out SVB with taxpayer money. Listen.
There's got to be a cap somewhere. Somebody can't, quote, deposit $1 billion, get a special deal from the bank, and still get backed up by taxpayers that they'll get their money back if the bank fails. That's not going to cut it.
And still get backed up by taxpayers. Wait a second, but Aaron, didn't the administration say taxpayers are not on the hook for what just happened?
Agreed. I think she really is contradicting this. And look, I agree that banks should be allowed to fail in certain cases, but look, blaming it on the Fed and Powell is a whole nother story.
Okay, because she also, speaking to our reporter there this morning, threw Jay Powell under the bus ahead of this decision. Listen.
He has raised interest rates at an extreme level, unlike anything we've ever seen in modern times. And it has certainly created problems throughout the banking system. And then secondly, we have a banking system that we've lost multiple banks now. And why? Because the Fed, under Chair Powell, has failed to supervise and regulate those banks as they are required to do by law.
Whoa, ouch. I mean, Jay Powell didn't create the inflation that he's been tasked with bringing down, to be sure.
So it's an interesting conversation because you and I have been talking about it for a while. You know, I've been negative on Powell with respect to saying it's transitory. And so he was playing catch up. And he used an immense number of blunt instruments, which is...
It wasn't just him, though. It was the Biden White House as well. They were not acknowledging inflation.
No, but...
And then they downplayed it.
Not true, because Powell has monetary policy, not the Biden administration. Monetary policy is the Fed. So let's just stay on that. He's increased it multiple times because he's playing catch up. So I understand Warren's point. I disagree with Warren's point on the supervision part, because the truth is, even Democrats approved, I probably would not have been there, but they approved to go from $50 billion to $250 billion on those banks that were deemed systemically important. I thought that was probably too much of a move. I would have been more at $100 billion. Silicon Valley Bank should have been supervised better. I agree. We should have seen the risk they were taking. That being said, That's not why they went under. They went under because they mismatched their assets and liabilities,
Okay.
and their earnings went down dramatically, and they tried to play catch-up.
All right, real quick, ahead of this decision, you saw the microphone up there in Washington. We're going to hear from Jay Powell. We're going to get the decision, and then he holds that news conference where then he sort of guides to what may happen next with monetary policy. But I'll put up on the screen the Fed rate hikes that are leading up to this moment. And this is a historic time for this country where we are living through this, and it will have a significant impact on us, not just today. We're starting to see that, but this will have a significant impact on us for some time to come. Aaron, if I put the high average loan rates up on the screen, this is what's happening to credit card rates. The average 20.1%, new car rates 6.5%, and as I mentioned earlier, the 30-year fixed rate mortgage 6.6% now. So this is happening now, and it will continue to happen if we keep hiking.
Yeah, totally agreed. And again, like I said, I think we should be raising rates because we have been seeing strong numbers. I agree. Like, the economy is doing well, and the only way to bring this inflation down, or one of the main ways to bring this, is to raise rates, even though it's painful.
Larry Kudlow says that's not the case. He says you could promote growth, and you will eventually cure all if you just promote growth.
You know, the economist debate.
I mean, listen, I think you've covered this better than anyone, but we are
Thank you.
at this inflection point of a recession or inflation. And this hard landing discussion we're having, my view is we're not going to get there, and I think we're more concerned about inflation. It impacts every American
How about I
every day.
add one more number 3, and I'll
Go
get
ahead.
last word if you don't mind. How about an acknowledgement that massive government spending got us here, and learn from those mistakes?
No question.
No question.
Okay, you guys still got last word. Thanks to both of you for joining us. All right, John.